Hey, what's going on, folks? This is Dan French. This is the Sound Off, and this is the French Wrap for the week ending in July 29th. Today's July 30th. So I just wanted to talk a little bit about what this week we saw this last week, give you guys a market analysis of what I see with data and some of the housing information that I see coming across the MLS. And the MLS is really a membership that, when you're out there looking for a house, it's a membership for real estate agents to provide information and data, and we're going to look into that today. So I'm going to talk a lot about this channel on Everything Las Vegas. I'm going to bring up a couple of things that I do outside of just real estate. I do have a YouTube channel that's related to real estate. It's a French Workbench podcast, also the LV Crib Tours. So you guys want to go over there if you can, check them out, subscribe, hit the notification bell, and really, try to be and help support those channels because I'm really trying to put out the most real and up-to-date information on real estate information here in Las Vegas and also across the country. I want to talk today about what's going on with inventory and how we're seeing across the country inventory increases really abroad. I mean, we haven't seen this at all in the last few years. I can't remember the last time we've seen almost every sector, every state, every city, for the most part, is increasing in inventory. We knew high prices and higher rates was going to drive the inventory levels up. And so we're going to talk about that today. We're going to talk about what's happening with mortgage rates, right? A lot of people always say, Dan, where's mortgage rates going? Are we going 7, 8%? So I'm going to touch on that. I'm going to give you guys some market information on what's going on with prices of homes and how much we've declined, and also what I see happening in the next 30 to 60 days in this market here in Las Vegas. So this is going to be your whole wrap up here on what I see happening with the market. Also, we're going to talk about what the Fed funds rate, what they did on Wednesday, which they've increased it, and the impact that's going to have. And then consumer confidence and inflation, that's going to be a big deal on all the videos we put out, because it plays a huge part in the way people think on either buying a home or just buying anything in general. So first off, I want to come over here and take a look at my website here. This is LV Home Professionals. This is a great place to get started. So what I've done is I've come over here, put in Las Vegas, and I have a minimum price point of $400,000, and then this one is going to be, let's put in $400,000 to $700,000. We saw 2684 as far as how many properties that are out there. So let's hit the search button. Well, what glares at me on this channel, or not on the channel, but on the website here, the link, and the properties that we see is reduced, right? Reduction. So reduced, foreclosure, open house, just reduced. So out there, I think this is a big topic that people need to talk about. If you're listing somebody's home, what I do is I get a home inspection and an appraisal, and I pay for it myself. Why? Takes out a lot of the guesswork. Also, if there's an issue with the house, we fix it before anybody really makes an offer on the house, and then we really price it aggressively. We're not going to try to lose money on the deal, but we have to do comps, look at what's sold. The appraisal is going to take care of all that. So that's something I do on all of my deals because, one, if let's say a buyer comes to me and says, oh, the value of that home is not worth what it is, we're going to offer you 20 below. I could turn around and say, well, we have an appraisal and a home inspection that I've paid for to perform on this house. That's going to help the selling point. We market the house on social media, and also it's just really about understanding that if you have to do open houses today, which a lot of people are starting to do again post-COVID, then you're starting to see that these houses are becoming more challenging. You really have to have a good agent out there. And the thing out there right now is that if you're out there trying to sell your house, you better sell it immediately, because if you go back to January of this year, you probably peaked out on the time period. I would say late December, right? December, January. That's probably the peak of when you should have sold your house. If you did that, or at least put it on the market, then you would be in good shape. Doesn't mean you don't come in and buy. I have a lot of people that come in and talk about, buying into houses, even when it's not a good market, because they always make a profit. And there's a lot of truth to that. Not everybody though is in a market to buy, and we understand that. But if you had to buy, or you're looking to buy, and you're, comparing whatever it is with rent versus your mortgage payment, a lot of times, if you have a family and you have to find a house, I would rather try to at least attempt to pay myself forward by paying a mortgage, getting into a house, than paying somebody else's rent. Now, over here, this is a new construction. Now, I went out to Rainbow Crossing, okay, and this is right down the street from me, really. There's 3 homes out there, 2 Juliets and a Pierce. and they're move-in ready homes. Slash prices, 35,000, 65,000. They're giving 6% in seller contribution if you use the lender for the builder. I mean, these are huge deals, and these builders are losing margins in profit. So that's why they're going in all in to try to get these houses off the books and move inventory. But if you come over here and you look at this website here, this is where, if you're looking for a new home, this is a great place to get started. This has access to all of the home builders out there, any inventory or anything that's out there to sell or buy, really to buy, not to sell, but to buy. They're selling these houses, right? They're selling these move-in ready homes. This is a great place to get started if you're looking for a move-in ready home, because it's going to have all this information here. So inventory homes, all new homes, see what's today. You just put in the information, plug it in, and you're off and running. Now, I'm also going to be putting in a lot of the new homes that I go search, especially the move-in ready homes, in this criteria. And you could find this on my website, LV Home Professionals, at the top. So let's go back and talk about where we're at today with the market. So the housing market has seen prices, I feel, somewhat come down, right? The prices of homes are starting to come down. We can see it. We've declined about 8%. If you know, and you've been watching my channel on my other podcasts and my other channel, if you come over here, we're going to take a look at this. So this is new homes, not new homes, but existing homes that, have been selling. These are resale homes. Okay. This is what we're talking about. So this is $465,000 is the average median price of a home now. Okay. You got days on the market is almost 30 days. That's the average. So we're starting to see the declines. Now, a lot of people out there think it's going to keep going 40%, 60%, 80%. Well, I mean, that's not going to happen. I really am a strong believer in what I see with the data. There's confidence out there, although we're going to look at that chart here in a second. But you could see that 465,000 is the number. We were at 495,000 not too long ago. I would say at least like 3 or 4 months ago, maybe in January, right? We saw a huge spike, and we saw prices of homes just going week by week. It was just crazy. I think we got up to 495. Well, now we've declined, right? We're at 465. Whatever area that those houses are in, and the average sale of a home is now declined to 465, and I feel like it's going to keep going. I feel we're going to probably correct about 20%. So really, if you had a home last year, you appreciated 23%, and you wanted to sell, well, at the peak would be January. That would have probably made you the most money, right? If you had it for a year and a half, 2 years. Now it's like, okay, well, how far are we going to go down? I think it's going to be maybe 20%. Maybe that's where we'll cap out. And I think that's, it's just, we're going to lose everything all the appreciation that we saw last year. I don't feel like it was a real market anyways. But if you're looking at these new homes, this is all the homes. What's sold is at 465, and you can see what's active right now is 7,782 homes. This is for single family residence homes, and the average home that's selling right now is 13 days on the market. So if you take an average of all 8,000 homes in single family residence, right now we're over 9,000 homes, all homes, right? Townhomes, condos, everything out there, right? If you take all types of homes, we're over 9,000 right now. But you could see 8,221 is how many homes that are in status right now of single family residence. Out of those that's sold to 439, the average sale of a home right now is 465,000. Price per square foot, $262.77. Now, this is good information, right? Everybody out there, again, this is taking a blend of everything that's out there on the market that's single family residence and putting it as a whole. So that doesn't mean it's going to be the same for Summerlin or Henderson, because those typically price out at higher cost per square foot. But let's go over here. I want to look at the next one here. And so let's bring this up. I want to bring this up as far as what I see. So here you see 465 is the number. And this is exactly what I was talking about. And that's your average median price home. Okay, that's for all homes on the market. Here you got 465 is your total close price. And your list price is 468. That means it's still, they're getting slightly less, or they're getting the offer accepted slightly less than list price, but it's being listed more aggressively. So let's take a look at your cost per square foot. Like we just said, $262. You have 465 is the closing price. So that's 439 out there right now that's sold this last month, and then or this last week, excuse me. And then if you look here, this is the last 7 days. You have total active is 7782, and like I said, you have a total amount of homes for all types over 9,000. If you come over to this one, this is going to be your town. This is going to be your townhomes, and the townhomes right now, days on the market are 12, but they're right here overall. They're about 30 days, 29 days, right? And you can see that in the townhome section, they're listing the price but getting a little bit above because that's more of a competitive market. Now, what we're seeing here is that you have townhomes and condos. Those buyers that were pushed out, that were forced to go to townhome and condo, now they're waiting because I think as you see the prices of homes coming down, they want to go back into that single-family residence position, right? So you're starting to see this drop a little bit. This is closing just a little bit lower on $241 a square foot, cost per square foot. And you have 690 that's still listed active on the market. Let's go over to the high rise. Here's the high rise section. This is selling for a little bit higher. There was only, in all of that, it was like, I think total was 23 sold, which you can see. And you had a total of 431 active only on the market. So there's not very many high rises on the market, but you can see that this is sitting on the market a little bit longer. And you can see the cost per square foot is quite a bit higher. And the average is $391. So there's not a lot of people moving towards high rises. It's a certain niche, probably a certain investor, or maybe you're trying to live that lifestyle. That's what you want. But you can see that 23 have been sold, and this is over the last 7 days. So you can see where we're at. The average right now is $423 per cost per square foot, and the close price average. This is the median price, but the average is $449,000. So when you come over here, we can look at this chart. I want to see, this is a single family residence chart. This is where the 480 is at that everybody talks about. Like, oh, we're at 480. So you can tell that if you're doing a last 7 day average or moving average, we're significantly lower at 465 for a single family residence home than 480,000. We're about an 8% drop, right? A little over 8%. So you can see how these prices have spiked. If you look at the days on the market, if you're going to go off of this and you say, okay, it's 8, well, the average days on the market is 17 days. The month supply we have right now is 2.3 here in Las Vegas. That's an increase, though, of 76%. So that's a huge deal. And then let's look at homes for sale total. Let's go talk. So this is for just single family residence. Remember, now if we go and click all types, you're over 9,000 homes. And this is just increasing. I just saw this yesterday at 9,030. And this is just continuing to go up because, again, everybody right now is on the sidelines. They're waiting. The supply chain is really starting to come up because prices of homes haven't really come down. Nationally, we've come down on the price. We're about 11% right now still increase. But we were at like 23% month to month, right? 25%. We've seen it huge numbers. You look at San Francisco. San Francisco has just had a decline, and the decline was like 0.5. The average home in San Francisco is $1.5 million. That's just to get started into a home there. Crazy amount, crazy high numbers there. Florida's held steady. There's still 29% increase year over year on price of home, and people are still buying into Florida. That's kind of the outlier, one of the states that's an outlier that you're starting to see those growths. But for across the board, all across the country, like I said, we've had increases in inventory. That's really a big deal because we haven't seen these numbers like this in a very long time, and it shows that inventory hopefully will correct the market, including with the stuff we talk about with inflation and also the Fed. But let's go back over here and we'll look at where we're at with the condominium sector. So the condominium right now, you have 945 condominiums on the market right now. And if you want to look, you can see the sales price. The average sales price we talked about was $245. Well, it's a little bit higher, right, on this than just on the condo sector. I'm sorry, the townhome sector. So you look at the townhomes and we're at $347, and here the median is $352. So that median is always going to be a little bit higher. But as you can see the moving average. If you go back, let's go back and take a look. This is the townhome. It's $324. So you can see that it's coming down, and I think that's the point I'm trying to explain to you is that when you see a townhome like this and you're seeing it's $352, you can see that the average price over the last 7 days is selling for a lot less. Just the average price, right? The median price. And then if you look at the average price, it's even further down. But So if you look at the average, compare it to this, which is 324,000, you can see that they're still getting, from majority of the properties, you're seeing that they're coming in and maybe offering the closed prices, that they're closing a little bit higher, but you can still see overall the averages are coming down across the board. Now, what I want to bring up as well is, here's a chart, and somebody brought this up to me. So this is a closed price to list price, meaning whatever you listed your home at versus whatever you closed at. And this is for the month of July. So you could see in the $600,000 to $700,000 range, they're closing at like 99 now. At the ultra luxury, that's like 1 out of 10, right? You're looking at 96%. That means that buyers in this market or in this price range are coming in offering less, and sellers don't have enough buyers to take on the amount of homes or inventory. So what's happening is it's suppressing those price ranges. And you could see 600 to 700,000. I've always seen in this was like a very competitive market here still. This is the first time I've seen this month that it's actually declined. So let's go over here and take a look. I want to take a look at, that's the GLVR. So here you have the original price, median price versus the sales price. And you could see the original price that was listed was at 400,000. You can see in July is come down. So the sales price, you can see, has been coming down really since the month of April. A lot of it is with rates. A lot of it is because of just economic uncertainty, the fast pace of prices of homes going up so high. So this is a great indicator that we're trending in the right direction for inventory, but we also want a healthy, balanced market. We don't want it to keep going that direction. Here's the last chart I'm going to look at. These are expired listings. This means that they've expired. They never sold their house. If you look at the month of June, there's a reason behind that. So June had the highest level of mortgage rates, right? The highest level. Middle part of June, we started to see that the bonds were selling higher and rates started to come down. But leading into June, you had the highest rates until we started to decline. So June is that month where you started to see a shift or a change, because you can see the number of expired. Now you're seeing that it's back to what it was at 390, and this was at 396, but here it was 660. That means in the month of June there was more properties not selling, and those listings just expired. So I want to go over here, and we're going to talk a little bit about the Fed, and we're going to talk about what's happening with inflation and what I see. So personal consumption expenditure, right? You can see the inflation numbers are just going up, right? You can see it. So we see this on the Fed chart, and we all know that that's going crazy. You have different measures of inflation trends. You can get all this stuff online, but this kind of tells you what people or what they're being spent on. You have the mean PCE inflation. I'm not going to get into detail on this because it's a very long process of talking about that, but you have to think that people are looking at these. Hopefully they're looking at these charts and getting that information. Now, coming over here, this is consumer confidence. And this is a big factor in any market, right? It's in crypto. It doesn't matter what market you're buying into. You have to believe in it. You can see this has gone down significantly recently. And so you come all the way to the month of June, you can see that, man, we're maybe the lowest. I mean, you got to think, look, the lowest we saw was 1980, and here's where we're at. We're pretty low here as far as consumer confidence. There's just not a lot of confidence in buyers today. So I want to go back. We're going to talk about what happened with the Fed. So that's enough on the market with the housing market. I want to talk about what's going on with the Fed and what the impact this will have on our market here in Las Vegas and across the country. So like I said, the bond price in June was up. That means that has an inverse relationship. That means that rates have come down. So I think that I get this question all the time, which is, where is rates going? Are we going to go to 7, 8, 9%? No, I don't think we are. I think that the Fed is trying to tame inflation. They're also trying to keep the unemployment numbers in check. We have a very low unemployment. And so I think we've topped out. I think we've plateaued based upon what I see. So I always look at the next 30 to 60 days. And I feel that we're going to be heading into, there's a lot of economists out there think, we still have some things to look at. Some of them feel like we're in a recession, right? Because we're going, because you see the data, you see that gross domestic product, 2 quarters of retraction on our economy. It's an unhealthy economy, so they're feeling we're in a recession. Well, that might be true, but you also have to look at the average American out there and what they perceive. And also you have to look at and say, well, what is the impact on mortgage rates and where are rates going to go based upon what the Fed's trying to do? Well, the Fed has objectives of, or just keeping inflation in check. They want to have price stability, and they also want to have where they keep in check on the unemployment or the employment market, right? You don't want to have too low of unemployment because it's actually not healthy for the market or the economy as well. So their whole position is how to balance that out, like pull a string, right? And so they're looking at this information, and you're saying, well, what are rates going to do based upon what the numbers we just saw? Well, they just raised the Fed's fund rate 75 basis points. This is back to back of what they raised previously. This hasn't happened since, I think since Magic Johnson in the 90s. They were running with the Lakers. It's like that's how far back we go. It's in the 80s since they did that. And they did it because of such high inflation. Now, the numbers and the data is saying that we're starting to slow down, and they're going to continue to evaluate it. The Fed came out and said we're not in a recession. Okay, they said this is not happening, even though the definition is if you're retracting for 2 quarters, you're technically in a recession. So, okay, what does the average American consumer out there think? Well, you could see the confidence that we saw, that they have no confidence in this market. You can also think that maybe they're perceiving that we were already in a recession before the data comes out. You're not going to have the average person out there that has to work a job, pay their bills, looking at data and economic information to say, oh, yeah, I think we're in a recession. They go by the eyeball test. They go by and say, well, man, I can't afford the same things I used to buy. I have to save my money. That's a big key, right? Save my money, or spend my money on necessity things, not non-necessity things. Gas prices, everything. Insurance, people trading their cars in because they just can't afford all of the payment with everything else that goes with it. So yes, people are feeling it in their pocketbooks. And I feel that a lot of people already thought we were in a recession, regardless of what the Fed comes out and says or not. Now, does that mean, this is going to be an unhealthy market? I don't know, because maybe the market needed this. Healthy versus unhealthy, they always want growth. They always want, but if you have something that it's imbalance, right? You have goods and services that have imbalance, then it throws the dynamic or the flow of the economy off. And that's what's happened, especially with COVID. So maybe this is normal. Maybe this is a healthy way to correct itself, because it was an artificial market for housing. We know that all these things and these costs and all this stuff that we're paying today is because of low chain supply. So you have to take all these things in consideration. You look at the 10-year Treasury yield with mortgage rates, we've come down a full point. That's another indicator that I feel like we've stabilized. So there's a lot of data out there and information that says we're probably going to be hovering between 5 to 5.5, maybe a little bit higher than that, all the way into 2023. And so that even might sustain all the way through 2023, where we start to stabilize with these rates. Now, what does that do psychologically for people? Well, if you can bring inflation down and they can adapt to those new rates, it takes time, and they could still afford a mortgage and still pay their bills and still afford things beyond that, then you're going to bring back the confidence. When all of the sectors are just going off the charts, then you're going to have low confidence that people have. So unfortunately, that's what's going to happen, right? So we've seen that happen with people buying houses. We see it right now in the markets. And so what do I see happening? Like I said, again, in my opinion, if you're looking at the next 30 to 60 days, I feel that the rates have stabilized. I don't feel we're going to need to go to 7, 8, 9%, because the Fed may not have to raise rates again, right? The Fed's fund rate. The only way that they would probably do that is if the data comes back and they don't see that we're heading back to the 2% target rate for inflation, or if the unemployment stays low, right? Because that does have an impact as well. So there's a lot of information out there that you guys could look at. I want to bring up one thing here, and we can come over here. So people always say, well, what are rates doing today? Well, how does this impact people buying? Well, let's talk about it. So 30-year fixed rate, if you go to Freddie Mac right here, you can see it's a 5.3 cost. We were at above 6. The national average was over 6. Right now, 5.3 with almost a point discount cost, meaning it would cost you a point. It's not bad. It's not good either, right? It's not like what it was, but it's not bad compared to what we've seen. So you could see this, right? This is all data and information you could see online. I think as long as people can kind of adjust to that market, adjust to higher rates, prices of homes continue to come down, and then you have this blending act of price stability and home affordability coming back to that average buyer out there. If you have rates coming down where, yes, they might have to go up, and they might be where they're staying higher now, but we're in a more of a normal market now, then you have costs of goods coming down, gas is starting to come down. We know that the rates are still continuing to come down. Hopefully it brings that confidence back, because that's really the root of everybody buying a house, is sustaining the payment. It's a big commitment, and everybody understands that, as the economy goes and as your pay goes, like your wages, that's always going to be a thing here. Can I pay my bill? Can I get my wages increased as fast as inflation, or as fast as some of these prices of homes are going up with that mortgage? We saw a lot of people couldn't do it. So I also want to bring up one last thing before we end this here. This is my this is not my podcast, but this is my my channel where I tour homes, and I wanted to bring this up. This is kind of what I go through here, and let's just kind of take a look at this real quick. All right, guys. It goes white, green, and then they take it all the way to the base. So what I do here is I just really give my opinion on what's happening within the new home sector. We're going to do it a lot more resale, because that's really starting to come out. I think a lot of people were forced or wanted to go new home, because when you look at the comparison of existing versus new, same with rents. There was inflation across the board for rent, also housing payments, rent payments, and also if you're buying into a new home, usually there's a huge or bigger difference than buying a resale home. But resale homes went up so quick, so fast. There was a very small margin. Plus, there was not a lot of homes for resale in the market. Nobody was listing their home. They had nowhere to go, right? So you're starting to see that's correcting itself, where you have more resale homes on the market. So that market is starting to thrive. We saw over 9,000 homes. So that's it. I think if you guys have any other questions, please let me know. I'm a real estate agent out here with Key Realty. I'd love to earn your business. You'll have all my contact information in the comment section. Like the channel, subscribe. There's the links. If you guys are looking for a resale home, if you're looking for a new home, move-in ready homes, we're going to do 2 of those a week. And also anything as far as reductions in prices of homes, open houses, we have all those links in the comment section. Like, subscribe, and I will see you guys at the next one. I'm out of here.